Before we begin, it's crucial to understand that the information in this video is for educational and informational purposes only. I am not a licensed financial advisor, mortgage broker, or real estate professional. The content provided here is not intended to be a substitute for professional financial advice. The mortgage and real estate markets are complex and subject to change. You should always consult with a qualified and licensed professional who can assess your individual financial situation before making any decisions. Your financial circumstances are unique, and the strategies discussed in this presentation may not be suitable for you. Imagine two couples, the Jacksons and the Millers. They both live in the same city, earn almost identical incomes, and have saved up the same amount for a down payment. They even find nearly identical houses they want to buy for $400,000. On paper, they are the same. But 6 months later, the Jacksons are paying over $700 more every single month for their mortgage than the Millers are. Over the 30-year life of their loan, that small difference will cost the Jacksons over $250,000. That's $250,000, enough to buy a second property, fund their retirement, or put multiple kids through college. What was the difference? It wasn't luck. It wasn't a secret connection. The Millers simply understood a few key principles about how the mortgage game is played in the United States, principles the Jacksons had no idea even existed. Today, you're going to learn those principles. Because let's be honest, trying to buy a home right now can feel like you're fighting a battle with both hands tied behind your back. You see interest rates on the news and they seem to only go in one direction, up. It feels like a force of nature you have absolutely no control over. A giant wave threatening to wash away your dream of homeownership. You might be thinking, what's the point? The rates are the rates, and I'll just have to accept whatever the bank gives me. That feeling of powerlessness is exactly what lenders count on. But I'm here to tell you that while you can't control the Federal Reserve, you have far more power over the interest rate you are offered than you think. The final number you see on that mortgage document isn't just pulled out of thin air. It's a calculation. It's a risk assessment of you. And if you know what they're looking for, you can systematically improve your profile to look like the safest, most attractive borrower on the planet. This video is your playbook. We're going to break down the 5 most critical tips for securing the lowest possible interest rate on your mortgage. These aren't vague suggestions. They are concrete, actionable strategies that can save you tens or even hundreds of thousands of dollars, just like the Millers. So let's get into it. Tip number 1. You must become obsessed with your credit score. I know you've heard it before. Your credit score is important. But that's like saying oxygen is important. It fails to capture the sheer, absolute, make-or-break gravity of this 3-digit number in the world of lending. Your credit score is not just a number. It is the single most powerful lever you can pull to change your financial future. To a lender, it's a direct reflection of your reliability. It's your financial report card, your trust score. A high score screams, I pay my bills on time, I manage my debt responsibly, and I am an extremely low risk. A low score whispers, I might be a liability. And lenders charge a massive premium for that perceived risk. Let's put some real numbers on this. Most lenders price their interest rates in tiers based on FICO scores. For example, a borrower with a 760 FICO score or higher is considered top tier, the absolute gold standard. They get the best advertised rates. A borrower with a score between 700 and 759 is still very good, but they might pay 1/8 to 1/4 of a percentage point higher. Someone with a score from 660 to 699, you could be looking at a half point or even a full percentage point higher than the top-tier applicant. And below 660, the penalty gets even steeper. A single percentage point sounds small, right? But on that same $400,000 loan, a 6.5% interest rate versus a 7.5% interest rate is the difference between a monthly payment of $2,528 and a monthly payment of $2,796. That's a difference of $268 every single month. Over 30 years, that 1-point difference costs you an extra $96,000. Just for having a lower credit score. Getting your score from good to excellent is literally the highest paying job you can give yourself in the months leading up to buying a home. So how do we do it? First, you need to know exactly where you stand. Not the fake score from a free credit app, but your actual FICO scores that lenders will see. The law entitles you to 1 free credit report from each of the 3 major bureaus, Equifax, Experian, and TransUnion, every single year. The only place you should go to get this is annualcreditreport.com. That is the official government-mandated site. Go there, pull all 3 reports and print them out. Next, you're going on a treasure hunt for errors. A Johns Hopkins study found that a staggering 34% of Americans have an error on their credit report. A Federal Trade Commission study found 1 in 5 people had an error that was serious enough to result in a less favorable interest rate. This is insane. You could have done everything right, but a simple clerical error, a paid-off debt still showing as active, a late payment that wasn't actually late, an account that doesn't even belong to you, could be costing you a fortune. Go through each report with a fine-tooth comb. Every single line item. If you find anything that looks wrong, dispute it immediately. Every bureau has a straightforward online dispute process. This is not optional. This is step 1 in taking back control. Now let's talk about the fastest way to actively boost your score: your credit utilization ratio. This sounds complicated, but it's simple. It's the amount of revolving credit you're using divided by your total credit limit. If you have one credit card with a $10,000 limit and you have a $5,000 balance on it, your utilization is 50%. To lenders, a high utilization ratio signals that you might be overextended and relying on credit to live. It makes them nervous. The golden rule is to keep your overall utilization below 30%. But if you want to be in the elite tier, you need to aim for under 10%. So if you have a $30,000 balance across all your cards, pay it down aggressively until it's under $3,000. This one action alone can cause your score to jump 30, 50, even 100 points in just a couple of months. Of course, the foundation of it all is on-time payments. One single 30-day late payment can crater your score and will stay on your report for 7 years. There is zero excuse for this. Set up automatic payments for at least the minimum due on every single one of your accounts: credit cards, student loans, car payments, everything. This creates a safety net so that even if you forget, the payment is made and your perfect payment history remains intact. Finally, and this is a mistake countless homebuyers make, in the 6 to 12 months before you plan to apply for a mortgage, you need to enter a financial lockdown. Do not open any new lines of credit. Don't apply for that new retail store card to save 15%. Don't finance a new car. Don't co-sign a loan for anyone. Every time you apply for new credit, it results in a hard inquiry on your report, which temporarily dings your score. Multiple hard inquiries in a short period of time make you look desperate for cash in the eyes of a mortgage lender. Equally important, do not close any old credit card accounts, even if you don't use them. A huge part of your credit score is the average age of your accounts. If you close your oldest credit card, you can dramatically shorten your credit history overnight, which can actually lower your score. And by closing an account, you reduce your total available credit, which can instantly increase your credit utilization ratio, delivering a nasty 1-2 punch to your score. The strategy is simple. Put your credit profile on ice. Pay your bills on time, keep your balances low, and don't make any sudden moves. Treat your credit score like a fragile masterpiece you are preparing for the world's most important art show. Because for a mortgage lender, that's exactly what it is. But that masterpiece, that pristine credit score, it can't just hang in a void. It needs to be displayed on a strong, stable wall. And in the world of mortgages, that wall is your debt-to-income ratio, or DTI. This is our second tip, and it's arguably just as critical as your credit score. Lenders are obsessed with it. So what is it? Imagine a classic balancing scale. On one side, you pile on every single one of your monthly debt obligations. We're talking your car payment, your student loan minimums, the minimum payments on all your credit cards, any personal loans, child support, alimony, everything that you are legally required to pay to someone else each month. Now, on the other side of the scale, you place your total gross monthly income. That's your salary, your wages, your bonuses, all the money you earn before taxes and deductions are taken out. Your debt-to-income ratio is simply the percentage of your monthly income that is already spoken for by your existing debts. If you earn $5,000 a month, and your total debt payments are $2,000, your DTI is 40%. Simple math, but it tells a lender a profoundly important story about your financial life. It tells them how much breathing room you have. It's a stress test. A high DTI screams risk. It tells a lender that you are stretched thin, that you're living on the financial edge. One unexpected car repair, one medical bill, one temporary layoff could be the gust of wind that sends your whole financial house of cards tumbling down. And if you're already struggling to manage your current debts, how on earth are you going to handle a new, and likely very large mortgage payment every single month for the next 30 years? That's the question flashing in giant, neon red letters inside a loan underwriter's mind. Let's make this real. Meet two applicants, Jessica and Mike. They both want to buy a $400,000 house. They both have the exact same 780 credit score, truly excellent. They also both earn the exact same gross income, $8,000 a month. On the surface, they look like identical, perfect candidates. But let's look under the hood. Jessica has been diligent. She paid off her car a year ago. She has one student loan with a $300 monthly payment and a couple of credit cards that she pays in full, so her minimum payments are only about $100 total. Her total monthly debt is $400. Her DTI is 400 divided by 8,000, which is a tiny 5%. She has massive financial breathing room. Now let's look at Mike. Mike has a fancy new SUV with a $700 monthly payment. He has significant student loans totaling $800 a month, and he's carrying balances on several high-interest credit cards, with minimum payments adding up to another $500. His total monthly debt is $2,000. His DTI is 2,000 divided by 8,000, which is 25%. Still manageable, right? But now let's add the proposed mortgage. The principal, interest, taxes, and insurance on that $400,000 house comes out to roughly $2,800 a month. For Jessica, her new total monthly payment would be her $400 in existing debt plus the $2,800 mortgage, for a total of $3,200. Her new DTI would be 3,200 divided by 8,000, which is 40%. The lender looks at this and sees a responsible borrower who can comfortably handle the new payment. They offer her their best interest rate. For Mike, his new total monthly payment would be his $2,000 in existing debt, plus the $2,800 mortgage, for a total of $4,800. His new DTI would be 4,800 divided by 8,000, which is a staggering 60%. More than half of his pre-tax income is now going to debt. The lender sees a massive risk. They might deny him outright. Or, if they do approve him, they'll slap him with a much higher interest rate to compensate for that risk. That higher rate could cost him tens, even hundreds of thousands of dollars over the life of the loan. Same income, same credit score, wildly different outcomes, all because of DTI. So what are the magic numbers? Lenders typically look at two types of DTI. The front-end ratio, which is just your proposed housing payment against your income, and the back-end ratio, which is all your debts, including the new house, against your income. While rules vary, a gold standard is to keep your back-end ratio, the all-inclusive number, below 43%. This is a key threshold for what's called a qualified mortgage, a category of loans with features that make them more stable and less risky for borrowers. But here's the secret. To get the best rates, you want to be well below that. Lenders love to see a DTI of 36% or lower. Getting your DTI into that sweet spot shows them you're not just surviving, you're thriving. It makes you a prime, low-risk candidate deserving of their most competitive offers. Okay, so how do you wrangle this beast? How do you lower your DTI? There are only two levers you can pull. Increase your income or decrease your debt. Increasing your income is the tougher, longer-term play. It means documenting a raise, getting a promotion, or establishing a consistent history with a side hustle. Lenders need to see at least a 2-year history for most non-traditional income, so it's not a quick fix, but it's incredibly powerful. The more immediate and controllable lever is decreasing your debt. And the time to start is now. 6 months to a year before you even think about applying for a mortgage, you need to go on a debt-crushing mission. Pick a strategy, the debt snowball, where you pay off the smallest balances first for psychological wins, or the debt avalanche, where you target the highest interest debt first to save the most money. It doesn't matter which one you choose. Just choose one and be relentless. Attack your credit card balances. Every dollar you pay down on a revolving credit card balance not only lowers your DTI, it also improves your credit utilization, giving your credit score a double boost. Look at your car loan. Is it possible to pay it off ahead of schedule? Can you throw an extra $100 a month at it? Every payment you eliminate is a permanent reduction in your DTI. And this leads to the most important rule of all in the pre-mortgage period. Do not, under any circumstances, take on new debt. This is a financial lockdown. You are not buying a new car. You are not financing a new living room set. You are not opening a new store credit card to save 15% on a t-shirt. I have heard absolute horror stories. A couple was pre-approved, they found their dream home, they were 1 week from closing. The guy thought, hey, we're moving, we'll need a new truck to haul stuff. He went to a dealership and financed a $60,000 pickup. The lender, as they always do right before closing, did a final credit pull. They saw the new $900 monthly payment. His DTI shot past the acceptable limit. The financing fell through. The entire deal collapsed. They lost the house, and they lost their $6,000 earnest money deposit. All for a truck he could have waited one more week to buy. Don't be that guy. Your DTI is the second pillar of your mortgage application. If your credit score is the story of your past reliability, your DTI is the forecast of your future stability. It's the math that proves you can handle the responsibility you're asking to take on. Get it as low as humanly possible. Pay things down, hold off on new purchases, and present yourself not just as someone who has paid their bills in the past, but as someone with a wide, comfortable financial margin for the future. That's how you get lenders to stop seeing you as a risk and start seeing you as an investment. And the most powerful, most undeniable way to prove you're a great investment is to put more of your own money on the line. This brings us to the second and arguably most impactful strategy for securing a rock-bottom interest rate: the down payment power play. We've all heard the golden rule, the number whispered in every home buying article and by every well-meaning relative: you need 20% down. For decades, this has been presented as the non-negotiable price of entry into homeownership. But have you ever stopped to ask why? Why is 20% the magic number? The answer isn't just about tradition, it's about risk. And understanding this is the key to unlocking a lower rate. When you put down less than 20%, lenders see you as a higher risk. If the housing market dips and you default on your loan, they have a smaller equity cushion to protect them from losing money. To compensate for this added risk, they force you to pay for something called private mortgage insurance, or PMI. Now, let's be crystal clear about what PMI is, because the name is incredibly misleading. It is not insurance for you. It does not protect you if you lose your job or can't make your payments. PMI is insurance that you pay for on behalf of your lender to protect them from you. Think about that for a second. It's like being forced to pay for your landlord's home insurance policy. You get absolutely no direct benefit, but the cost comes straight out of your pocket every single month. And that cost is not trivial. PMI typically costs between 0.5% to 1% of your total loan amount per year. Let's put that into real numbers. Say you're buying a $400,000 house and you put down 10%, or $40,000. That leaves you with a loan of $360,000. 1% of that is $3,600 a year. That's $300 added to your mortgage payment every single month. $300. That's a car payment. That's a week's worth of groceries for a family. That's a significant chunk of your budget vanishing into thin air, paying for an insurance policy that does nothing for you. And it continues for years until your loan balance drops to the point where you have 20% equity in your home. Avoiding PMI is a massive financial win, and it's the most obvious reason to push for that 20% down payment. But here's the secret that most people miss. The down payment isn't just an on-off switch for avoiding PMI. It is a dimmer switch for your interest rate. A larger down payment does more than just save you that $300 a month. It directly influences the interest rate the lender will offer you in the first place. Lenders operate using a metric called the loan-to-value ratio, or LTV. It's simply the loan amount divided by the home's value. A 20% down payment gives you an 80% LTV. A 10% down payment is a 90% LTV. A 5% down payment is a 95% LTV. Here's the critical part. Lenders have internal pricing tiers based on this LTV. These are invisible to you, the borrower, but they have a huge impact on your rate. Think of it like this. Crossing certain LTV thresholds unlocks better pricing. Going from a 95% LTV to a 90% LTV might not just lower your PMI, it might also shave a little bit off your interest rate. But the big jump, the one that really moves the needle, happens when you cross that 80% LTV threshold. And it gets even better if you can push further, say to a 75% LTV, which means a 25% down payment. Let me tell you about two hypothetical buyers, Sarah and Mike. They're both looking at similar $400,000 homes. They have identical credit scores and incomes. Sarah is eager to buy now. She's saved up $40,000, a respectable 10% down payment. She gets a loan for $360,000, gets hit with PMI, and is offered a mortgage at, let's say, 6.5%. She's thrilled to be a homeowner. Mike, on the other hand, decides to wait one more year. He gets aggressive. He picks up some freelance work, cuts back on a few luxuries, and manages to save an additional $40,000, bringing his total down payment to $80,000, or 20%. He goes to the exact same lender, Because he's putting 20% down, his LTV is 80%. First, the PMI is completely gone. That's an instant savings of a few $100 a month. But more importantly, the lender's pricing engine now sees him as a much lower risk. He has more skin in the game. So instead of 6.5%, they offer him a rate of 6.25%. A quarter of a percent. It sounds so small, doesn't it? You might think, who cares? Mike waited a whole year just for that. Well, let's do the math. On Sarah's $360,000 loan at 6.5%, her principal and interest payment is about $2,275 a month, plus her PMI. Mike's loan is smaller, $320,000, and at 6.25%, his payment is about $1,970 a month. With no PMI, he's paying over $300 less every single month just on principal and interest before we even account for the PMI savings. Over the 30-year life of the loan, that tiny quarter-point difference will save Mike over $38,000 in interest payments. $38,000. That's a new car. That's a kitchen remodel. That's a significant portion of a college fund. All because he understood that a down payment isn't just a hurdle to clear. It's a weapon to be wielded. So how do you build this weapon? How do you amass a down payment that puts you in the driver's seat? The first step is the most boring but also the most crucial. Automate your savings. The moment your paycheck hits your account, have an automatic transfer set up to move a fixed amount into a separate, high-yield savings account labeled down payment. Don't even let yourself see the money. This pay-yourself-first strategy is the foundation of all serious wealth building. Second, consider a dedicated income stream. This doesn't mean you have to burn yourself out driving for a rideshare service 40 hours a week. It means finding one specific high-leverage skill you can monetize and dedicating 100% of that income to the down payment fund. Maybe you're great at editing college application essays, or you can build simple websites for local businesses, or you're the go-to person for assembling complicated furniture. Find that one thing, charge a fair price, and funnel every dollar directly into that savings account. An extra $1,000 a month becomes $12,000 in a year. Combined with your regular savings, that can dramatically accelerate your timeline. Third, don't be afraid to explore gift funds. Many first-time buyers get help from family, but you can't just have your parents drop $20,000 into your checking account a week before you apply for a loan. Lenders will see that as a red flag. They need to verify the source of all funds to ensure it's not a secret, undocumented loan that adds to your debt. The proper way to do this is with a formal gift letter. It's a simple document where the person giving you the money signs a statement saying the funds are a true gift with no expectation of repayment. Your lender will provide you with the exact template they need. It's a simple piece of paper that can make a world of difference. Finally, look into down payment assistance programs or DPAs. These are often state or local government programs designed to help homebuyers. They can come in the form of outright grants that don't need to be repaid, or as silent second mortgages with zero interest that you only pay back when you sell the home. These programs can be an incredible resource, but they often have income limits and may require you to take a homebuyer education course. A quick search for down payment assistance in your state will show you what's available. By focusing on your down payment, you fundamentally change your relationship with the lender. You're no longer just a supplicant asking for a loan. You are a partner, bringing a significant capital contribution to the table. Every extra $1,000 you save is more than just money. It's leverage. It's proof of your discipline. It is the clearest possible signal that you have skin in the game, and it transforms you from a simple borrower into a prime investment. So you've perfected your credit, you've crushed your debt, and you've built a formidable down payment. You are, on paper, the perfect applicant. But now comes the most overlooked and potentially most costly mistake that even the most prepared buyers make. They walk into their local bank, the one they've used since they were 16, and they take the first offer they get. In the next part, we're going to break down why shopping for a mortgage is the single highest leverage financial activity you will ever perform, and how to run the process like a seasoned pro to make lenders compete for your business. Let's start with a simple, brutal truth. For most Americans, their mortgage will be the single largest debt they ever take on. It's a financial decision that echoes for decades. So why is it that we'll spend weeks, even months, researching the best $50 a month cell phone plan, but when it comes to a multi-$100,000 loan, we spend less than an hour comparing options? The Consumer Financial Protection Bureau, the CFPB, found that nearly half of all homebuyers seriously consider only one lender before signing on the dotted line. 1. That is a catastrophic financial mistake. It's like walking onto a car lot, pointing at the first sedan you see and saying, "I'll take it," without ever asking the price or looking at another car. Let's put this in perspective with some hard numbers because this is where it gets real. Let's imagine you're taking out a $400,000, 30-year fixed-rate mortgage. You talk to your primary bank, the one where you have a checking account, and they offer you a rate of 6.5%. Seems reasonable. You're excited to buy a house, so you're tempted to just accept it and move on. But you decide to make a few more calls. Another lender offers you 6.25%, a quarter of a percentage point. It sounds so small, doesn't it? What's the big deal? Over the life of that loan, that tiny quarter of a point will save you over $54,000. $54,000. That's a brand new luxury car. That's a down payment on an investment property. That's multiple college funds. And what if you found a lender offering 6%? That's a half-point difference. The savings there? Over $105,000. Let me ask you a question. If I offered you a job that paid $105,000 for 5 hours of work, would you take it? Of course you would. You'd drop everything you were doing. That is what you are doing when you shop for a mortgage. You are performing the highest paid work of your entire life. Every single phone call, every application, is you earning thousands, potentially tens of thousands of dollars per hour. There is no other financial activity that even comes close to this level of return on your time. So if the stakes are this high, why don't more people do it? There are 3 big myths, 3 psychological traps that keep people from saving a fortune. The first and biggest is the fear of damaging your credit score. We've been trained to believe that every time a lender pulls our credit, our score takes a hit. And while that's generally true, mortgage and auto loan inquiries are a special exception. The credit scoring models like FICO are smart. They know you're not trying to open 10 different mortgages at once. They know you're rate shopping. So they have what's called a shopping window. Any mortgage-related credit inquiries that happen within a specific period, typically 14 to 45 days, depending on the scoring model, are bundled together and treated as a single inquiry. Let me repeat that because it is critical. You can apply with 10 different lenders in a 2-week span, and it will have the same impact on your credit score as applying with just one. The fear of wrecking your credit is a myth. Do not let it cost you $50,000. The second trap is simple inertia and overwhelm. The home buying process is already stressful. You're dealing with agents, inspections, and negotiations. The idea of adding another complicated task, filling out multiple applications and talking to a bunch of salespeople, feels exhausting. People think, my bank is easy. They already have my info. This is a cognitive shortcut that banks count on. They're banking on your fatigue. But remember the hourly rate. Framing it as the highest paying job you'll ever have is the mental shift you need. It's not just another task. It's the one task that pays more than all the others combined. The third trap is misplaced loyalty. You've been with your bank for 10 years. You know the teller by name. Surely they'll give you the best deal, right? Wrong. In fact, they might be the least likely to give you the best deal. They're assuming they already have your business. They don't feel the need to be as competitive because they're relying on your relationship. Loyalty in banking is rarely a two-way street. Your only loyalty during this process should be to your own financial future. So, how do you actually run this process like a pro? Here is your step-by-step playbook to make lenders compete for your business. Step 1. Prepare your arsenal. Before you talk to a single loan officer, gather all your financial documents. We're talking the last 2 years of W-2s and tax returns, your last 2 months of pay stubs, and your last 2 months of bank and investment account statements. Scan them all and have them in a single folder on your computer, ready to deploy. When you approach lenders with all your documents ready, you signal that you are a serious, organized, and desirable borrower. It makes their job easier, and they will take you more seriously. Step 2. Fire the first shot. Choose one lender to begin the process. It doesn't matter who. It could be a big national bank, a local credit union, or a well-known online lender. Go through their full application process. Yes, it will take some time. The goal here is to get your hands on an official, legally binding document called a loan estimate. Step 3. Understand your weapon. The loan estimate is a standardized, 3-page form created by the government for one reason: to make it incredibly easy for you to compare loan offers. This is your key to everything. You don't need to be a financial wizard to understand it. You only need to focus on a few key boxes on page 1 and page 2. Look at the interest rate, of course, but also look at the APR, or annual percentage rate. The APR includes not just the interest rate but also most of the lender's fees, giving you a more accurate, all-in cost of the loan. Then on page 2, look at Section A, origination charges. This is the pure profit the lender is making on your loan. This is a major area for negotiation. Step 4, the blitz. This is where the magic happens. Once you have that first loan estimate in hand, you unleash the blitz. On the same day, or at most within 2 days, you are going to contact at least 4 to 5 other lenders. It is crucial to compress this timeline to take advantage of that credit score shopping window and to create a sense of urgency. Your goal is to get a loan estimate from each one of them. And don't just call the same type of lender. You want a diverse portfolio. Contact a big bank like Chase or Bank of America. Contact a local credit union in your town. Contact a mortgage broker who works with dozens of wholesale lenders. And contact a major online lender like Rocket Mortgage or Better. Each of these channels has different overhead costs and different pricing models, meaning one of them is likely to be significantly cheaper than the others. Step 5. The negotiation script. Do not just ask these new lenders, "What's your best rate?" That's an amateur move. It invites a sales pitch. Instead, you go in with confidence and leverage. You call or email them and say this word for word. "Hi, I'm under contract for a home, and I'm ready to lock in a loan. I already have an official loan estimate from another lender for a 30-year fixed loan at 6.5%, with $1,000 in origination charges. I've attached it for your review. Can you beat this offer?" This script does 3 powerful things. First, it shows you're a serious, qualified borrower, not a tire kicker. Second, it gives them a concrete target to beat. And third, it immediately turns the conversation from a sales pitch into a pricing negotiation. You've set the terms. Step 6. Create a bidding war. As the new loan estimates roll in, you'll almost certainly get a better offer. But you don't stop there. You take the new best offer. Let's say it's from the mortgage broker, at 6.25% with $900 in fees, and you go back to the other lenders including the first one. You call them up and say, "Thank you for the initial quote. I've just received a competing loan estimate at 6.25% with lower fees. I'd prefer to work with you if you can match or beat that offer." You rinse and repeat this process. You are now in the driver's seat, creating a reverse auction where massive financial institutions are fighting each other to give you a better deal. This process might take you, in total, 5 to 8 hours of focus work. But those hours will be the most profitable of your life, saving you tens or even hundreds of thousands of dollars. You've turned the tables. Instead of being a passive applicant hoping for a good deal, you've become a savvy shopper orchestrating a competition for your business. Now, once you've secured that rock-bottom interest rate by making lenders fight over you, you might think you're done. But there's another hidden factor. A silent killer of your monthly budget that can completely wipe out the savings from a great rate. And it has absolutely nothing to do with the loan itself. I'm talking about your PITI. Principal, interest, taxes, and insurance. You've just spent all this energy fighting tooth and nail for the interest rate. But the T and the I, taxes and insurance, are the assassins in the shadows. They can inflate your monthly payment by hundreds, sometimes even thousands of dollars, making your hard-won low-interest rate feel almost meaningless. This is our third tip, and it's the one most people completely ignore until it's too late. Master your pity by investigating taxes and insurance before you even make an offer. Let's start with the silent giant. Property taxes. You see a house listed for $400,000. You run the numbers with your great new interest rate, and the mortgage payment looks perfect. You buy it. Then your first real mortgage bill comes, and it's $500 higher than you calculated. Your heart sinks. What happened? Property taxes happened. See, property taxes are determined by 2 things. The assessed value of the home and the local millage rate, which is the tax rate set by your county, city, and school district. And this rate can be wildly, almost absurdly different from one town to the next. Let me give you a real-world example. In parts of upstate New York, the effective property tax rate can be over 3%. In parts of Delaware, just a couple of states away, it can be under 0.6%. On that same $400,000 house, that's the difference between paying $1,000 a month in taxes in New York versus just $200 a month in Delaware. That's an $800 a month difference. Over the life of a 30-year loan, that's $288,000. That's more than half the value of the house, completely separate from the mortgage itself. It's not even a hypothetical. You can have 2 identical houses built by the same builder, on identical plots of land, just 10 miles apart but on opposite sides of a county line, and one will cost you thousands of dollars more per year forever. So how do you protect yourself from this? You become a detective. Before you fall in love with a house, you need to find its tax history. Don't just trust the estimate on a real estate website. Those are often inaccurate. You need to go to the source. Google the county name followed by property tax assessor or tax collector. Nearly every county in the United States has a public searchable database online. You type in the address, and it will show you the home's assessed value and the exact amount of taxes paid over the last several years. Look at the history. Are the taxes stable or have they been jumping up every year? A big jump could be a red flag that the area is undergoing major reassessments. Also, look for special assessments. This is a temporary, extra tax for a specific local project, like new sewers or sidewalks. If you buy a house with an active special assessment, that bill becomes your problem. Finally, call the local tax office. Ask them if there are any planned rate hikes or countywide reassessments coming up. A 5-minute phone call can save you from a 5-figure mistake. You absolutely must know the exact tax figure for the house you want to buy, because your lender will build that number directly into your required monthly payment. Ignoring it is like planning a budget for a car but forgetting the cost of gas. Okay, so you've investigated the taxes. You're in the clear, right? Not yet. Now we have to talk about the other silent partner in your payment. Homeowners insurance. Lenders require you to have it. It's not optional. And just like taxes, the cost can vary dramatically. You might think, oh, it's just $100 a month, no big deal. But for some properties, it can be $300, $400, even $500 a month. Imagine you find your dream home. It's a beautiful older house with tons of character. You get a great interest rate, the taxes are reasonable, and you make an offer. Everything is going smoothly. Then, a week before closing, you get your insurance quote. It's astronomical. Why? Because the insurance company discovered the roof is 25 years old and needs replacing. Or maybe the house has old, outdated electrical wiring that's a fire hazard. Or perhaps it's in a designated flood zone, or a high-risk wildfire area in California, or a hurricane-prone part of Florida. Suddenly, your affordable monthly payment is anything but. The insurance premium alone has torpedoed your budget. I saw this happen to a couple who were buying a house with a beautiful backyard pool that had a diving board. They were so excited. What they didn't know is that many insurance companies see a diving board as a massive liability risk and will either charge an insane premium or refuse to cover the property at all. They had to scramble at the last minute to find a specialty insurer, and it cost them nearly double what they had budgeted. The solution here is simple, but almost no one does it. Shop for insurance while you are shopping for a house. The moment you get serious about a property, before you even make an offer, call your insurance agent. If you don't have one, call a large independent broker who works with multiple companies. Give them the address. They can run a preliminary report called a CLUE report, which shows the claim's history on that specific property. They can identify major red flags right away. Things like a history of water damage claims, its location in a floodplain, or the age of the roof. Getting a quote takes maybe 15 minutes, and it is one of the most powerful things you can do. It gives you leverage. If the quote comes back high because of an old roof, you can now use that information in your negotiation with the seller. You can say, I love the house, but it's going to cost me $15,000 for a new roof just to get affordable insurance. You need to either replace the roof or lower the price. Without that insurance quote, you're negotiating blind. By investigating taxes and insurance up front, you transform the mysterious pity into a known quantity. You're no longer just looking at a sale price and an interest rate. You're looking at the true all-in cost of living in that home month after month, year after year. This isn't just about saving a few bucks. This is about financial certainty. It's about protecting yourself from the number one cause of buyer's remorse. The shock of a monthly payment that's way higher than you ever expected. You can have the best interest rate in the world, but if your taxes and insurance are out of control, you still lose. So you've mastered your credit, you've made lenders compete for your business, and now you've become a detective, uncovering the hidden costs of taxes and insurance. You are in total control of your monthly payment. You're ready to choose a loan and sign on the dotted line. But what if I told you the very structure of the loan you choose, the decision that seems the most straightforward, could be a secret trap designed to cost you over $100,000 in extra interest? The choice seems simple, but for 99% of Americans, one of these options is a massive financial mistake. The answer is hidden in the single most debated question in the world of mortgages. Should you get a 15-year or a 30-year loan? On the surface, the 15-year mortgage seems like the responsible, intelligent choice. It's the one your parents might recommend. It comes with a slightly lower interest rate, and you pay it off in half the time. The math is undeniable. Over the life of the loan, you pay dramatically less in total interest. Case closed, right? That's what 99% of people think. And that's why they fall into the trap. Let me introduce you to two friends, Alex and Ben. They're both hardworking, both financially savvy, and they both decide to buy a house at the same time. They find identical houses in the same neighborhood for the exact same price, $500,000. After making identical down payments, they both need to get a mortgage for $400,000. This is where their paths diverge. Alex decides to be aggressive, to be responsible. He goes for the 15-year mortgage. The bank rewards his ambition with a nice, low interest rate of 6%. His monthly principal and interest payment comes out to be about $3,375. It's a steep payment, but Alex is proud. He's on the fast track to owning his home free and clear. He calculates that over those 15 years, he'll pay about $207,000 in interest. Not bad. Now let's look at Ben. Ben takes a different approach. He opts for the 30-year mortgage. Because the term is longer and slightly riskier for the bank, his interest rate is a little higher, let's say 6.5%. His monthly principal and interest payment is only $2,528. That's $847 less than Alex's payment every single month. But Ben looks at the total interest and feels a small pang of regret. If he takes the full 30 years to pay it off, he'll have paid over $500,000 in interest. That's almost $300,000 more than Alex. This is the exact moment the trap snaps shut. This is where most people stop their analysis. They see that $300,000 difference and they immediately conclude the 15-year loan is the only smart move. They've looked at the cost of debt, but they've completely ignored the power of opportunity. Ben understands this. He knows the secret. He takes that $847 difference in their monthly payments and he does something very simple, very disciplined. He sets up an automatic transfer. Every single month, that $847 goes from his checking account directly into a low-cost S&P 500 index fund. He never touches it. He just lets it grow. Let's fast forward 15 years. It's a huge day for Alex. He makes his final mortgage payment. He pops a bottle of champagne. He owns his $500,000 house, completely debt-free. His net worth in terms of his house is $500,000. He feels like he won the race. But what about Ben? For 15 years, he's been making his smaller $2,528 payment. He still has 15 years of payments left on his mortgage. He still owes the bank a significant amount of money. But what about that investment account? That $847 he's been investing every month for the last 180 months. Assuming a conservative historical average return of 8% on the S&P 500, Ben's investment account is now worth over $290,000. So let's compare. After 15 years, Alex has his $500,000 house. Ben has a house with a significant amount of equity in it, plus a liquid investment portfolio of nearly $300,000. Who is in a better financial position? Who has more wealth? It's Ben, and he's just getting started. Now let's fast forward another 15 years to the 30-year mark. Alex has been living mortgage-free for a decade and a half. This is great, of course. He's had an extra $3,375 in his pocket every month. Maybe he invested it, maybe he spent it on vacations, maybe he upgraded his car. Life happened. For most people, without the forced discipline of a payment or an automatic investment, that money just disappears into their lifestyle. On the other side of the street, Ben makes his final $2,528 mortgage payment. He now also owns his $500,000 house free and clear. But what about his investment account? For 30 years he has relentlessly, automatically, invested $847 every single month. That account, after 30 years of compound growth at that same 8% return, is now worth over $1.2 million. Let me repeat that. Alex has a paid-off house. Ben has a paid-off house and $1.2 million in the bank. This brings us to tip number 3. Choose your loan term for flexibility, not just for the lowest total interest. The 15-year mortgage is a financial straitjacket. It forces all of your extra cash into one single illiquid asset, your house. You can't easily spend your home equity if you lose your job. You can't tap it for a business opportunity without taking out another loan. It gives you zero flexibility. If you have a medical emergency or a sudden income loss, that massive $3,375 payment is still due. It's an incredibly fragile strategy that looks good on paper, but can shatter under real-world pressure. The 30-year mortgage is financial freedom. It gives you options. It offers you a permanently lower required monthly payment, which is a powerful safety net. When times are tough, you can just make the minimum payment and weather the storm. When times are good, you have a choice. You can either pay extra on your mortgage, effectively turning it into a 15-year or 20-year loan on your own terms. Or you can do what Ben did and use the difference to build true liquid wealth in the stock market, which has historically outperformed real estate and the guaranteed return of paying down a low-interest mortgage. The trap is believing that your home is your best investment. It's not. For most Americans, it's a place to live. A truly powerful financial strategy uses your home as a foundation, but it builds your wealth elsewhere. The 30-year mortgage is the tool that allows you to do that. It separates your living expenses from your wealth-building engine. It allows you to put your money to work in the most powerful compound growth machine ever created, the stock market, while still enjoying the benefits of homeownership. So when you're sitting across from a loan officer, and they show you the amortization schedules side by side, ignore the siren song of the total interest paid column on the 15-year loan. Look instead at the monthly payment on the 30-year loan. See the difference not as a failure but as an opportunity. See it as your monthly investment capital, your seed money for building a future that isn't just debt-free, but truly wealthy. Choosing the right loan term is a monumental step. But even if you pick the perfect 30-year mortgage, there's a secret number hidden in your loan documents that lenders hope you'll ignore. It's presented as a small one-time fee, an insignificant detail in a sea of paperwork. But in reality, it's a powerful lever that can save you, or cost you, tens of thousands of dollars over the life of your loan. And in the next part, I'm going to show you exactly what it is and how to control it. That lever is called mortgage points. And if you've ever glanced at a loan estimate, you've probably seen it. It's usually a single-line item, a fee listed under origination charges that seems deceptively simple. Most people either ignore it, or they ask their loan officer, "What's this?" Get a quick, jargon-filled answer and just move on, assuming it's another non-negotiable cost of doing business. But this single-line item is one of the most powerful negotiation tools you have. It's the difference between a good mortgage and a great one. So what are they? In the simplest terms, mortgage points, also called discount points, are a form of prepaid interest. You are paying a fee to the lender upfront at closing, in exchange for them giving you a lower interest rate for the entire life of your loan. Think of it like this. Imagine your Netflix subscription is $100 a month, but Netflix comes to you and says, "Hey, if you pay us a one-time fee of $600 today, we'll drop your subscription to $80 a month, forever." Would you do it? Well, it depends. You'd have to do the math. How long would it take for that $20 monthly savings to cover the initial $600 cost? That exact calculation is the secret to mastering mortgage points. Let's walk through a real-world story. Meet Sarah and Tom, a couple buying their first home. They're smart, they've saved up, they have great credit, and they get two different loan offers for a $400,000 mortgage. Offer A is straightforward, an interest rate of 6.5% with 0 points. The closing costs are exactly what they expected. Offer B is a little different. The interest rate is lower at 6.25%. But there's a catch. On the loan estimate, there's a charge for 1 point, and it costs $4,000. Tom's immediate reaction is what most people's would be. $4,000? That's a huge fee. Let's just go with offer A. The rate is barely different, and we can use that $4,000 for furniture or an emergency fund. Feels like a trick, an extra way for the bank to squeeze money out of them. But Sarah, being a bit more skeptical, decided to dig deeper. And what they discovered changed everything. First, they learned that 1 point is almost always equal to 1% of the total loan amount. Their loan was for $400,000, so 1 point cost them exactly $4,000. That part was simple. The real magic happened when they calculated the monthly payments. For offer A, the 6.5% loan, their monthly principal and interest payment would be $2,528. For offer B, the 6.25% loan, their monthly payment would be $2,462. The difference was $66 a month. Tom scoffed again. We're going to pay $4,000 upfront just to save $66 a month? That sounds like a terrible deal. But this is where 99% of homebuyers stop thinking. They see the big upfront cost and the small monthly saving and they walk away. But Sarah pushed forward and asked the single most important question you can ask when it comes to points. What is our break-even point? The break-even point is the moment in time when your accumulated monthly savings equal the initial cost of the points. The formula is simple. Upfront cost divided by monthly savings. In their case, it was $4,000 divided by $66. The answer? 60.6. It would take them 60.6 months or just a hair over 5 years to completely pay back the cost of that point with their monthly savings. Suddenly, the decision wasn't about a big fee versus a small saving. It was about time. They sat down and had a serious conversation. Are we going to be in this house for more than 5 years? They loved the neighborhood, it was a great school district, and they had no plans to move. They fully expected to be there for at least 10 years, maybe even raise their kids there for the next 30. And that's when the light bulb went on. After that 5-year mark, every single $66 saving every single month for the rest of the loan was pure profit. It was money back in their pocket. Let's look at the numbers. If they stay in the house for 10 years, that's 120 months. Their total savings would be $66 times 120, which is $7,920. Subtract the initial $4,000 cost, and they've made a net profit of $3,920. They essentially made an investment that returned almost 100% in 10 years. But what if they stayed for the full 30-year term of the loan? The math becomes staggering. $66 a month for 360 months is $23,760. Subtract that initial $4,000 cost, and they will have saved a net $19,760. All because they chose to pay a fee that, at first glance, seemed like a ripoff. They turned a $4,000 expense into nearly $20,000 of savings. Now this is critical, buying points is not always the right move. The entire strategy hinges on your time horizon. If Sarah and Tom thought they might get a job transfer in 3 years, buying the point would have been a terrible financial mistake. They would have paid $4,000, only to save about $2,376 before they sold the house. They would have lost over $1,600. So the first rule of points is, be brutally honest about how long you plan to keep this specific mortgage. Not just how long you'll be in the house, but how long until you might refinance. Because when you refinance, you get a brand new loan, and the savings from the points you bought on your old loan disappear forever. But this lever works in both directions. What we just discussed are called discount points, where you pay money to get a lower rate. But there's an opposite concept, a secret weapon for buyers who are short on cash. They're called lender credits, or negative points. This is where you, the borrower, agree to take a higher interest rate than the market standard. In exchange, the lender gives you a credit at closing, actual cash back to be used towards your closing costs. Let's imagine another couple, Mike and Jessica. They have their down payment ready, but the thousands of dollars in closing costs, for things like appraisal fees, title insurance, and attorney fees, are stretching their budget to the breaking point. Their lender gives them an offer at 6.5% with 0 points. But they ask, what are our other options? The lender comes back and says, well, if you're willing to take a rate of 6.75%, we can give you a lender credit of $3,000. For Mike and Jessica, this is a game changer. That $3,000 covers a huge chunk of their closing costs, meaning they need to bring significantly less cash to the table. It makes the whole deal feel safer and more manageable. The trade-off, of course, is that their monthly payment will be higher for the life of the loan. But it might be the very thing that allows them to get into the house in the first place. They can always refinance to a lower rate in a few years when their financial situation improves. A lender credit is a strategic tool to solve a short-term cash flow problem. So our fourth major tip is this. You must strategically negotiate your mortgage points. This isn't a passive decision. It's an active one. When you talk to a lender, don't just ask, what's the rate? Ask for a full rate sheet with different options. You should see a par rate, which is the standard rate with 0 points. Then you should see options for buying points to lower the rate, and options for taking lender credits to raise the rate. Your job is to run the break-even analysis for your own situation. If you have the cash on hand and you are certain you'll be in the home for the long haul, buying points is one of the best, most guaranteed investments you can make. If you need cash to close and are willing to pay a little more each month, a lender credit can be the key that unlocks the front door. And if you're uncertain about your future plans, sticking with the 0% par rate is the safest, most flexible choice. By understanding this one concept, you transform yourself from a price taker into a savvy negotiator. You're no longer just accepting the numbers on a page. You're actively shaping the financial structure of the biggest purchase of your life. We've just turned a confusing line item into a powerful tool you can control. We've talked about the numbers, the rates, and the fees. But what if the very structure of your loan is costing you a fortune? There's a common loan type that sounds safe, that millions of Americans have, but for many people, it's a hidden financial trap. In the next part, we'll expose what it is and show you the smarter alternative that lenders might not be so quick to offer. That trap is the single most common mortgage product in the United States. It's the one your parents probably had, the one your friends are getting, the one that lenders will present to you as the default, the standard, the only sensible option. It's the 30-year fixed-rate mortgage. Now you're probably thinking, wait a minute, how can that be a trap? It's fixed rate. It's safe, it's predictable. And you're right, the payment doesn't change. That's the genius of the trap. It's not a trap because it's risky. It's a trap because it's outrageously, astronomically expensive. It's designed to do one thing exceptionally well: maximize the amount of profit the bank makes from you over the longest possible period. It's a 30-year sentence of paying mostly interest, and it has quietly drained trillions of dollars in wealth from the pockets of American homeowners. The entire sales pitch for the 30-year mortgage is built on a single seductive idea: the low monthly payment. The lender shows you two numbers side by side. On one side, a 15-year loan with a higher payment. On the other, the 30-year loan with a much lower, much more affordable monthly payment. Your brain immediately focuses on that lower number. You think, I can afford that. That fits my budget. They are selling you on cash flow, not on cost. They are getting you to focus on the monthly battle so you ignore the 30-year war you're about to lose. Let's expose this with real numbers. Let's imagine a $400,000 home loan. As of today, you might find a 30-year fixed rate at around 6.5%. Your monthly principal and interest payment would be about $2,529. That seems manageable for a lot of people. You make that payment every month for 30 years. At the end of those 360 payments, you will have paid the bank a grand total of $910,440. You borrowed $400,000, but you paid back over $910,000. That means you paid $510,440 in pure interest. More than the entire value of the loan itself. You bought a house for you and a second more expensive house for the bank, paid for entirely in interest. Now let's look at the smarter alternative that lenders are much less excited to talk about: the 15-year fixed-rate mortgage. Because it's a shorter term and less risky for the bank, they offer a lower interest rate. Let's say you get a rate of 5.75% for the 15-year loan. Your monthly payment would be higher. No doubt about it. It would be about $3,321. That's about $792 more per month. And this is where most people stop. They see that higher payment and say, no way, I can't afford that. Give me the 30-year. They just made a $500,000 mistake based on a $792 difference. Because look what happens. You make that higher payment for just 15 years, half the time. At the end of those 180 payments, you will have paid the bank a grand total of $597,780. Let's compare. With the 30-year loan, you paid over $910,000. With the 15-year loan, you paid under $598,000. By choosing the 15-year loan, you have saved yourself $312,660. Let me say that again. $312,000. That is a life-changing amount of money. That is college educations for your kids. That is a comfortable retirement. That is financial freedom. And it was just sitting there, waiting to be claimed by choosing a different loan term. But it gets even better. It's not just about the money you save. It's about the wealth you build. With a mortgage, your first several years of payments are almost entirely interest. On that 30-year loan, after 5 years of making payments, that's over $151,000 you've paid. You would have only paid down about $30,000 of your principal. You've paid the bank $121,000, and your actual ownership in the house barely budged. You're just renting money from the bank. Now look at the 15-year loan. After 5 years, you've paid about $199,000. but you've paid down over $93,000 of your principal. You are building equity, real ownership in your home 3 times faster. This means if you need to sell the house in a few years, you walk away with significantly more cash in your pocket. If the market dips, you are far less likely to be underwater on your loan. You own your home doesn't own you. Now I can hear the biggest objection loud and clear. But I truly cannot afford that higher monthly payment. It's not a choice, it's a necessity. I hear you. And for some people, that is absolutely true. But for many, there's a powerful strategy that gives you the best of both worlds. It's the secret weapon against the 30-year trap. Here's what you do. You take the 30-year fixed-rate mortgage. Yes, you heard me correctly. You take the 30-year loan with its lower required monthly payment. This becomes your safety net. If you lose your job or have a medical emergency, you know you only have to make that lower payment. But here's the key. You don't. You get an amortization calculator online, they're free, and you calculate what the monthly payment would have been for a 15-year loan at your same interest rate. And you religiously pay that higher amount every single month. Every extra dollar you send goes directly to your principal. It doesn't go to future interest. It goes to killing the loan balance today. By doing this, you are effectively on a 15-year payoff schedule. You will pay off your house in 15 years. You will save hundreds of thousands of dollars in interest. But you retain the flexibility of the 30-year loan in case of an emergency. You have the discipline of a 15-year plan with the safety net of a 30-year requirement. Even if you can't swing the full 15-year payment amount, the principal remains the same. Pay extra. Anything and everything you can. Let's go back to that $400,000 loan at 6.5%. Your required payment is $2,529. What if you just rounded up your payment to an even $2,800 every month? That's an extra $271. Doesn't sound like much, but that simple act of paying an extra $271 a month will shave nearly 7 years off your mortgage and save you over $123,000 in interest. What could you do with an extra $123,000 and no house payment for the last 7 years of your loan? There's another popular method called biweekly payments. Instead of making one monthly payment, you pay half of your monthly payment every 2 weeks. Because there are 52 weeks in a year, this results in 26 half payments. That's the equivalent of 13 full monthly payments per year, instead of 12. That one extra payment each year goes straight to the principal and can shave about 4 to 6 years off a 30-year mortgage, again saving you tens of thousands in interest. Many banks offer this service, or you can simply do it yourself by dividing your monthly payment by 12 and adding that amount to each month's payment. The bottom line is this. The bank's business model is to keep you as a paying customer for as long as possible. The 30-year mortgage is the perfect tool for that. Your goal should be the exact opposite. To pay them back and get them out of your life as quickly as humanly possible. Every extra dollar you pay towards your principal is a vote for your own financial future, not your lender's. Choosing the right loan term, or creating your own accelerated payment plan, is arguably the most impactful financial decision you will ever make. It is the foundation of building real, lasting wealth through real estate. So you've chosen the right loan term, but there's a secret way to slash your interest rate even further before you even sign the papers. It involves paying a little bit of money up front to save tens of thousands, or even hundreds of thousands over the life of the loan. It's called buying points. And in the next part, we'll break down exactly when it's a brilliant financial move, and when it's a complete and total waste of your money. So let's dive straight into one of the most powerful, yet most misunderstood tools in the mortgage world, discount points. Picture this. You're at the closing table and you have 2 choices. Option A is the standard loan everyone gets. Option B requires you to pay a little more upfront, an extra fee, but in exchange, the bank magically lowers your interest rate for the entire 30-year life of the loan. That's what buying points is. It's a deliberate strategic decision to prepay some of your interest in order to secure a lower rate and a lower monthly payment for decades to come. Think of it like buying a bulk package at Costco. You pay more today, but your per unit cost is lower over the long run. In the mortgage world, a point is a fee that typically costs 1% of your total loan amount. So, on a $400,000 loan, 1 point would cost you $4,000 paid at closing. In return for that $4,000, your lender might reduce your interest rate by, say, 0.25%, maybe from 7% down to 6.75%. You can often buy multiple points or even fractional points like half a point or 1/4 point to fine-tune your rate even further. Now, 0.25% might not sound like a lot. It's easy to dismiss, but this is where the power of 30-year amortization kicks in. On that $400,000 loan, dropping the rate from 7.0% to 6.75% would lower your monthly principal and interest payment by about $67. Again, $67. You might be thinking, I'm paying $4,000 just to save $67 a month? That sounds like a terrible deal. And you'd be right if you only looked at it for 1 month. But you're not. You're looking at it for up to 360 months. Over the full 30-year term, that seemingly small rate reduction would save you a staggering $24,000 in total interest. You paid $4,000 to save $24,000. That's a 6-to-1 return on your money. Suddenly it sounds a lot more interesting, doesn't it? The entire decision, the whole complex strategy, boils down to one simple critical calculation: the break-even point. This is the single most important number you need to know. The break-even point is the exact month where the total amount you've saved in lower monthly payments officially equals the upfront cost of the points you bought. After that month, every single payment you make puts pure, unadulterated profit back in your pocket. Let's stick with our example. You paid $4,000 for the points. You're saving $67 each month. To find the break-even point, you just divide the cost by the monthly savings. So, $4,000 divided by $67 is 59.7. That means it will take you just under 60 months, or exactly 5 years, to recoup the initial cost of buying that point. And this reveals the fundamental question you must ask yourself. How long am I realistically going to have this specific mortgage? Not how long you'll live in the house, but how long you'll have this loan. If the answer is more than 5 years, buying the point is a brilliant financial move. If the answer is less than 5 years, it's a complete waste of money. You'd be giving the bank a $4,000 gift. So, when is it a genius move? First and foremost, if this is your forever home. Let's imagine a couple, Mark and Sarah. They've just found the perfect 4-bedroom house in a great school district. They plan to raise their kids there, watch them graduate, and maybe even host grandkids one day. They are not moving for at least 15 to 20 years. They have healthy savings, so paying an extra $8,000 at closing for 2 points isn't a problem. This drops their rate from 7% all the way down to 6.5%. Their break-even point might be around 6 or 7 years. For them, this is a no-brainer. For the next 13, 15, or even 23 years after they break even, they will be reaping the rewards, saving hundreds of dollars a month, tens of thousands over the life of the loan. They made a short-term investment for a massive long-term gain. It's also a smart move for someone who prioritizes a low, fixed monthly payment above all else. Maybe you're a financial planner or just very budget-conscious, and you want your housing costs to be as predictable and low as possible for the next 30 years. You have the cash on hand, and you value that long-term security. Buying down the rate gives you peace of mind and locks in a permanent advantage. Now for the other side of the coin. When is buying points an absolute financial blunder? The most common mistake is for the short-term homeowner. Let's think about Alex, a young software engineer getting a starter condo. Alex is ambitious and knows that in 3 to 4 years, a promotion, a new job in another city, or starting a family is highly likely. The lender offers Alex a great deal. Pay $3,000 to buy down the rate. Alex runs the numbers and finds the break-even point is 5 years. If Alex moves in year 4, that $3,000 is gone forever. Alex would have been far better off keeping that cash in an emergency fund and just paying the slightly higher monthly payment for the short time they're in the home. Never, ever buy points if you aren't confident you'll stay in the loan past the break-even point. The second huge mistake is for the cash-strapped buyer. Getting into a new home is expensive. You have the down payment, closing costs, moving expenses, new furniture, and the inevitable surprise repairs. If paying for points means you have to drain your savings account to zero, you are putting yourself in a dangerously vulnerable position. Liquidity is your best friend as a new homeowner. Having a robust emergency fund is infinitely more valuable than saving $80 a month on your mortgage. Don't sacrifice your financial security for a slightly lower rate. And finally, perhaps the most relevant reason for today's market. It's a terrible idea if you plan to refinance soon. We're currently in a higher interest rate environment. Many people taking out mortgages today are fully expecting and hoping to refinance into a new loan with a lower rate in the next 18 to 36 months when the market shifts. If that's your plan, buying points is like paying for a premium, front row ticket to a concert and then leaving after the opening act. You're paying a huge upfront cost for a benefit, the lower rate, that you plan to throw away as soon as a better opportunity comes along. You will almost certainly not reach your break-even point before you refinance, flushing that money down the drain. But it gets even more nuanced. A pro tip: the value of a point is not standardized across lenders. One lender might offer you a 0.25% rate reduction for 1 point. Another, more competitive lender might offer a 0.375% reduction for that same 1% fee. This makes your break-even point much shorter and the deal much better. You must ask every lender you speak with, what is your price for 1 discount point? And exactly how much will it lower my rate? Compare these offers apples to apples. And here's a final advanced strategy. You can even do the opposite. It's called taking a lender credit or using negative points. You can ask the lender to give you a slightly higher interest rate than you qualify for, and in exchange, they give you a cash credit to help cover your closing costs. This is an amazing option for that cash-strapped buyer we talked about. You get into the house with less money out of pocket, and if you plan to refinance in a couple of years anyway, that slightly higher rate doesn't matter in the long run. Ultimately, the decision to buy points is a deeply personal math problem. It's a calculation based on your finances, your timeline, and your goals. It's not about getting the lowest possible rate just for bragging rights. It's about structuring the loan in a way that makes the most financial sense for your unique life situation. So you've done everything right. Your credit is stellar, your DTI is low, and you've masterfully negotiated points. But there's one final critical step that separates the amateurs from the pros. It's a simple conversation that can save you thousands, and it happens right before you sign on the dotted line. It's called locking your rate, and the timing of that lock is everything. In our final part, I'll reveal the exact signals to look for and the precise questions to ask to ensure you lock your rate at the absolute perfect moment, protecting yourself from any last-minute market shocks. This is where the game is won or lost. You can do everything else right: perfect credit, a huge down payment, you've shopped lenders until you're blue in the face. But if you fumble the rate lock, you can watch thousands of dollars in savings evaporate overnight. So, how do you become a master of timing? It's about watching for specific signals, both in the wider economy and in your own home buying journey. First, let's talk about the big picture. The U.S. economy. Mortgage rates don't live in a vacuum. They dance to the tune of economic news, and the biggest conductor of that orchestra is the Federal Reserve. You need to become a casual Fed watcher. You don't need a PhD in economics, you just need to know one thing: their meeting schedule. The Fed meets about 8 times a year to decide on the federal funds rate, which directly influences mortgage rates. In the days leading up to a Fed meeting, the market gets jittery. There's speculation. Pundits are debating. This is a period of high volatility. But when they make their announcement, the market reacts powerfully. If the Fed signals they're going to be aggressive in fighting inflation by raising rates, you will see mortgage rates climb, sometimes within hours. Conversely, if their announcement is more cautious than expected, what they call dovish, rates might stabilize or even dip. Here's the pro move. Look at the calendar of Fed meetings. If everyone and their brother is predicting a rate hike at the next meeting, your strategy is to lock your rate before that meeting takes place. You're essentially shielding yourself from the fallout of that announcement. Don't try to get cute and wait to see what happens. If the consensus is a rate hike, lock it in and protect your wallet. The second major signal is economic data, specifically 2 key reports: the Consumer Price Index, or CPI, which is the government's primary measure of inflation, and the monthly jobs report. Think of it this way: bad news for the economy can sometimes be good news for your mortgage rate. When the CPI report comes out and inflation is hotter than expected, lenders get nervous. They anticipate the Fed will have to raise rates to cool things down, so they raise their own mortgage rates preemptively. On the other hand, if a jobs report comes out and it's surprisingly weak, showing that the economy is slowing down, it might cause rates to dip, as the market bets the Fed will have to ease up. So you're not just a homebuyer anymore, you're a strategic observer. You know when the Fed is meeting. You know when the next big inflation and jobs reports are due. If you have a signed contract on a house and a hot inflation report is coming out next Tuesday, what do? You call your lender on Monday and you lock that rate. You take the certainty. You don't gamble with tens of thousands of dollars just to see if you can squeeze out another 1/8 of a point. Now let's move from the national stage to your personal stage. The most obvious signal to lock is when you have a signed purchase agreement on a home. Once that contract is in your hands, the clock is ticking. You are no longer just browsing, you are committed. At this point, letting your rate float, meaning not locking it in, is a high-stakes gamble. You're betting that in the 30 to 60 days it takes to close, rates are going to go down. That's a bet I wouldn't recommend my own family to take. The peace of mind that comes from knowing your monthly payment is secure is worth far more than the potential gain from a small rate drop. But there's a secret weapon you can ask for. A tool that gives you the best of both worlds. It's called a float-down option. Not all lenders offer it, and it's usually not free, but you absolutely must ask about it. A float-down option allows you to lock in a rate, protecting you if rates go up. But, and this is the magic part, if market rates drop by a certain amount before you close, you get to take advantage of that lower rate. It's a safety net with a trapdoor to even bigger savings. When you're talking to your lender, you need to ask these 4 questions word for word. Write them down. Question 1. What is the cost to lock the rate and for how long? Locks are typically for 30, 45, or 60 days. Always opt for a longer period than you think you'll need. Closing delays are incredibly common, and you don't want your lock to expire a week before you get the keys. Question 2. What are your rate lock extension fees? If your closing is delayed and your lock expires, you'll have to pay to extend it. These fees can be brutal, sometimes costing a percentage of the loan amount. Knowing this fee up front helps you compare lenders and prepares you for a worst-case scenario. Question 3, and this is the big one. Do you offer a one-time float-down option? If they say yes, your follow-up is critical. What are the specific terms? How much do rates have to drop for me to exercise the option? And what is the fee to do so? This question alone shows the lender you are a sophisticated borrower. You're not just taking what they give you. You are actively managing your financial future. And question 4. If I lock today, can you walk me through the exact numbers on my loan estimate, showing me the principal and interest payment, and the total cash to close? Get it in writing. Always. By mastering the timing of your rate lock, you're making the final and most crucial move in this entire chess game. You're no longer a passive passenger on this journey. You're in the driver's seat. So let's bring it all home. We've covered the 5 pillars of securing a mortgage that will build you wealth, not drain it. First, we treated your credit score like the financial superpower it is, cleaning it up to unlock the best possible terms. Second, we understood the immense power of the down payment, not just to avoid PMI but to fundamentally lower your interest rate for the life of the loan. Third, we turned you into a professional shopper, getting multiple loan estimates and making lenders compete for your business, saving you thousands right from the start. Fourth, we demystified the world of discount points and closing costs, teaching you how to read the fine print and make the mathematically correct decision, not just the emotional one. And finally, we just mastered the art of the rate lock, learning to read the market signals and ask the right questions to protect ourselves from volatility and secure the lowest rate at the perfect moment. The difference between a homebuyer who follows these steps and one who doesn't is staggering. We're not talking about a few $100s. Let's do the math on a $400,000 loan. The difference between a 7% interest rate and a 6.5% interest rate, just 0.5%, is over $43,000 in interest payments over 30 years. $43,000. That is a new car. That is a college fund. That is your financial freedom. This knowledge you now have is the key. It's what separates a stressful, expensive home buying experience from a smart, wealth-building one. You are now equipped with the information that most people only learn after they've made a costly mistake. You have the framework to walk into any lender's office with confidence, to ask the tough questions, and to demand the best deal possible. This isn't just about a house. It's about taking control of the single biggest financial decision of your life. It's about building a future where your money works for you, not the other way around. If this series gave you the confidence and the tools to take that next step, do me a favor and hit that like button. It tells the algorithm that this is valuable information that more people need to see. Subscribe and turn on notifications, because our entire mission is to give you the financial education you never got in school. And please share this video with a friend, a coworker, a family member, anyone who is dreaming of buying a home. You could be the person who saves them that $43,000. Now I have a question for you. What was the single most valuable or surprising tip you learned in this entire series? Drop it in the comments below. I read every single one, and I want to hear what resonated with you the most. Thank you for investing your time. Now go build your future.